When you start investing, even with small amounts of money, you're building the mental resilience needed for long-term investing. The truth is, most people don't fail at investing because they pick the wrong stocks. They fail because they panic when things go south and let emotions get the better of them. I've made a lot of mistakes that me today would never repeat, but honestly, I'm grateful for those. And because of that, I now have a strong foundation in investing. If you ever read the book The Psychology of Money, one of the biggest takeaway from the first chapter is financial success isn't how much you earn, it's about your habits, patience, and the ability to manage emotions when investing. Those are the things that truly determine whether you succeed in the long run. The very first chapter mentions somebody called Ronald James Reed. He was a janitor and a gas station attendant. Just an average guy, but through discipline, saving, and investing, he quietly built $8 million worth of fortune. Meanwhile, a high-earning investment banker lost everything due to reckless financial decisions. This just shows how building wealth isn't about how much you earn, but it's about how you manage it. My name is Ray. I talk anything about personal finance, investing, and saving money. 2024 was a milestone year for me because I crossed the $100,000 net worth mark. And honestly, I wouldn't have been able to do so if I haven't started investing. My biggest regret, and this is something every investor I know agrees on, is that I didn't start investing sooner. If I could go back in time and give my 13-year-old self some advice, I'll say, find a way to earn money and start investing before you even turn 18. Earlier you start, the more you can take advantage of compounding. My investment journey started 5 years ago in 2020. That just happened to be during the COVID crash when the markets were at a perfect low. When I started, I was all about individual stock picking. I had no idea what an ETF was, and I knew everything from YouTube itself. I spent hours watching videos with clickbait titles like top 5 stocks to buy right now. I didn't know anything about valuations or financial metrics, none of that. I just heard YouTubers hyping up certain stocks and thought, maybe that's a good stock to buy right now. I still remember the first stock I ever bought. It was Boeing. I bought it after it crashed during COVID because I thought it would be a decent recovery play. After buying the stock, it dipped another 10%. I panicked and I sold out because I feared for a second crash coming up. I'm bringing this up because not only is this a funny story of how I was when I started, but it's also something some of you will face when you begin investing. I've had incredible wins. Some stocks in my portfolio has gone up 1,000%, but I've also made huge losses. Stocks that dropped 30, 40, 50, and yeah, I even had one stock that completely went bankrupt and I lost everything. When you're starting out, market volatility feels unbearable. Any small dips make you question everything, and you find yourself checking stock prices every about 5 minutes or so. But over time, I've learned something crucial. You can't let emotions dictate your investing decisions. Over the past 5 years, my portfolio has grown by about 55%. Sounds good on paper, but when you compare it to the S&P 500 71% return over the same period, kinda underperforming if you look at it that way. Back in 2022, there was a time when my portfolio was actually outperforming the S&P 500. I felt like a genius back then. Every tech stock was going up, but as the saying goes, everybody is a genius in the bull market. But I didn't cash out and eventually all those gains disappeared. My portfolio crashed and I was back to square one. This experience taught me a lot. It wasn't until October 2023 that I bought my first ETF, and that completely changed the way I invest. I realized that instead of trying to time the market or pick individual stocks, the smarter approach was actually to invest in low-cost index funds. I chose an index fund that tracks the S&P 500, but you can of course choose whatever index fund that fits your investment goals. Most people go with funds that track broad market indices because they offer diversification, stability, and long-term growth. Statistically, index funds are one of the safest and most reliable ways to grow your wealth over time. Historically, broad market index funds have returned an average of about 8 to 10% annually, even accounting for recessions and market downturns. More importantly, research shows that over 90% of hedge fund managers fail to outperform the market over a 15-year period. These are professionals with extensive resources, data, and experience, yet most of them still can't consistently beat the indexes. If they are struggling, what are the odds that an average investor like me Picking stocks based on social media trends or gut feeling can do better. To be honest, I'm a pretty lazy person and I want my investing strategy to be as passive as possible. I don't want to stress over market movements, read earning reports every quarter, or guess which companies will outperform next. And that's exactly why I chose investing in index funds, which allows me to do all of it. The best way to invest is actually to take emotions out of the equation. If you can just consistently invest and dollar cost average or DCA, you will see results over time. It doesn't matter if the market is high, low, fearful, or greedy, those emotions are what stops most people from staying invested. I have a prime example. Let's say you're watching a stock like Palantir hit an all-time high of $30 and you think that's too expensive, I'll wait for a dip. And the dip never comes, it climbs to $40 and you tell yourself, maybe next time, and the same thing happens, but the dip never comes again, and instead it keeps running up to 50, 70, 100, and then one day 120. Now you're sitting there regretting not buying in earlier because you realize you missed out on a massive opportunity just because you were trying to time the market. That is what we call an opportunity cost. A high market can always go higher and a low market can always go lower. We will never know the perfect timing, and trying to wait for the right moment often leads to missing out on long-term gains. More money have been lost trying to time the market than it is to be in the market. That's why the best time to start is always now. If you want to wait for the perfect dip or for the market to settle, you might end up never investing. The most important thing is to get started and stay consistent and let time in the market do the work. I'm not saying you should only buy index funds, nor am I saying you shouldn't pick individual stocks, because I still do both. The key is to have a well-balanced portfolio that you firmly believe in and won't panic over the long run when the market takes a turn. At the end of the day, investing is about conviction. If you invest in good and solid companies with strong fundamentals, you'll have the confidence to hold through the bad times. Instead of panic selling when the market dips, that belief will carry you a long way, because no matter how volatile things get in the short term, quality investment tends to win over time. I believe in automating your investment to make it seamless and effortless, and that is one of the most efficient ways to invest. Every single month, I automatically invest $1,200. $400 goes into the QQQ and $400 goes into the S&P 500, and the rest stays in my brokerage accounts, either for buying individual stocks I believe in for the long term, or as cash for future opportunities to deploy when the market dips. There are plenty of low-cost index funds that track the major indices like the Nasdaq 100 and the S&P 500. But how do you know which one is the right one for you? For the Nasdaq 100, you've got options like the QQQ and the VGT, while for the S&P 500, there's the SPY, VOO, and a bunch of others. They all track the same index, but the small difference in fees, tax treatments, and structure can have a huge impact over time. That's personally why I chose with QQQM and CSPX. They give me the best balance of cost efficiency and tax advantages. I picked QQQM over the QQQ mainly because of the expense ratio. The QQQ charges an expense ratio of 0.2, while QQQM charges a slightly cheaper ratio at 0.15. Now that might not sound like a lot, but over decades of investing, those fees compound and slowly eat into your returns. Since both of them track the same exact Nasdaq 100 index, I'd rather go with the cheapest option and keep more of the gains for myself. Let's put that into perspective. Say you invest $10,000 into both the QQQ and the QQQM, and both of them earn an average return of 8% a year over the next 30 years. QQQ with an expense ratio of 0.2 will return you $96,949, while QQQM with an expense ratio of 0.5 will return you $98,718. That's an extra $1,769 just because of a tiny 0.05% difference. Now imagine if you're investing $100,000 or even $1 million, the gap becomes massive. If both ETFs do the exact same thing, why do you want to pay more? For my S&P 500 exposure, I chose CSPX, and the biggest reason is the withholding tax. Since it's an Ireland domiciled ETF, the dividends are taxed at 15% instead of 30%. There's also an inheritance tax factor. US domicile ETF can be subjected to estate taxes of up to 40% for non-US investors if your portfolio crosses $60,000. Ireland domicile ETF like CSPX don't have this issue, making them a much safer bet for long-term wealth planning. What this means is that if you one day pass away, your son and daughter inheriting your assets will take a 40% cut if your assets crosses the $60,000 mark. At the end of the day, there's no one-size-fits-all ETF, but these small decisions can make a big difference over time if you're investing for the long haul. It pays to be smart about fees and taxes because every little bit counts. So now that we've talked about ETFs and how small tax decisions can make a big difference, let's dive into my actual portfolio breakdown. I own a mix of individual stocks and index ETFs, but my approach is pretty straightforward. I just buy and hold. No complicated strategies, just letting my portfolio grow over time. I own mostly stocks in the US market. Here's how my portfolio stacks up, listed from the smallest to the largest position. SoFi, MasterCard, Google, Palantir, ASML, QQQM, CSPX, and Tesla. Some positions like Tesla have grown into their size over time. I haven't been adding to them, just letting them ride. The only position where I'm sitting in the red is SoFi. It's not a huge chunk of my portfolio, so even if it doesn't work out, I would not be affected. So besides the US stock, I also grabbed 100 shares of OCBC last year. I really wanted to get into some Singapore exposure in my portfolio for a little bit of diversification. OCBC just seems like a good fit. Strong fundamentals, they pay decent dividends. DBS was my first choice, but it was a little bit too pricey at the time. I didn't want to have to buy a minimum of 100 shares, which was about 4,000 Singapore dollars, which felt a little bit too much. So moving into 2025, I'll be looking at opportunities to add more Singapore stocks, particularly in the banks or REIT sector. To my portfolio as I get older, I would love to have a solid dividend stream that provides a steady cash flow alongside my growth-focused investment. Banks have been a strong and reliable choice in the Singapore market, but I'm also considering REITs because of its avenue for passive income. That said, REITs are an entirely new sector for me, and I believe in investing only in what I understand. So before diving in, I'll be doing my due diligence to make sure I know the risk and potential rewards that I will be getting myself into. If you're also interested in building a dividend portfolio, you might want to follow me along this journey, and I'll be sharing my research, thought process, and even the mistakes I make along the way. Because at the end of the day, investing isn't about being right all the time. It's about learning, adapting to the new market trends, and identifying the most undervalued and attractive asset class there is at any given time. The market is always changing, and the key is to stay flexible while keeping a long-term perspective. Looking back, my investing journey has been full of mistakes and learning experiences. I've chased hype stocks, missed time entries, and even panicked over short-term market dips. But each of these moments helped refine my mindset as a long-term investor. Over time, I've learned that staying invested and sticking to my strategy matters more than trying to time the market perfectly. And that leads me to the most important advice I'd like to share with you guys. Starting your investing journey can feel overwhelming, especially when the idea of putting your hard-earned money at risk. The fear of losses is real, and for someone new, it's easy to hesitate. But investing doesn't have to be scary. With the right research and risk management and a long-term mindset, you can navigate through any of these challenges. The key is to learn from them and manage your risk wisely and stay disciplined. So if you're just starting out, remember, this is not about being perfect, because in the end, the investor who succeeds aren't the one who never makes mistakes. They're the ones who stay consistent, keep improving, and never give up. If you have any questions, feel free to reach out to me on TikTok or Instagram, and I'll be happy to answer any of them. And if you find this video helpful or entertaining in any way, make sure to help like and subscribe and share this video with somebody that you might think wants to start on their investment journey. And I'll catch you in the next one.